Hello, good evening, good afternoon, and good morning. Welcome to this session of the World Investment Forum on sustainable investment cases for emerging markets. It's one of the last sessions of the forum this week. There's been nearly 100 sessions, and we've saved the best till last, I would say. We have an illustrious group of speakers with us today. And let me introduce the session for you and what it's about. So really, this is a more practically oriented session where we hear experiences and case studies of investors who have been trying to mainstream sustainability into their investments and who are invested in emerging markets or developing countries, as we sometimes refer to them in UNCTAD. For this session, we're going to begin with two stories from investors in developing countries. Angela Bai, who's the Secretary General of the China Association of Social Value Investment, and Noelle Tan, who's a Senior Client Professional and Deputy Member of the Impact Committee for PG Life at Partners Group, based in Singapore. Then, in the middle of the session, we'll have the perspective of Rahul Agarwal, Head of Institutional Investment and Senior Vice President at Invest India. And this is really the only perspective we have on the demand side in the session, to hear how they are attracting and supporting investors in India. Maybe we'll hear a little bit about their experience with investment in SDG-related sectors such as renewables or health. And finally, we go to two stories from developed countries. We have investors, asset managers based in developed countries, in developed economies. So we have Caroline Lemeux, who's Head of ESG Research and Engagement at Amundi Group in France, and Glenn Yelton, Head of ESG Client Strategies North America at Invesco. And there we'll hear a little bit about their experiences, some of their products and their product lines that are exposed to emerging markets and also that are trying to integrate ESG and sustainability measurement and outcomes into their investment products. So before we hear from the speakers, I'd like to also introduce my colleague Yongfu Ouyang, who's the Head of Institutional Investment at UNCTAD here in Geneva. And he's going to say a few remarks just to provide an introduction and also to set the context globally for sustainable investment and some of the issues that we'll be hearing about today. So Yongfu, over to you.
Hello, ladies and gentlemen, distinguished speakers. I'm very, delighted, to have you with us in this very important session. Our subject today is about sustainable investment in the emerging market. It is really a very important, subject for us. I believe you all know that, due to the COVID-19 crisis, the global direct investment falls dramatically last year by 35%, to decreased to dropped below $1 trillion. That's 25%, below the 2009-12 after the 2008 financial crisis. So it's a big impact on the global investment. And of course, it has significant implications for the growth of the world economy. If we look at the global capital market, I think at least we see we have one good news. That is, the global capital market and the institutional investors are increasingly aligning their investment with sustainable development as defined by the SDGs. According to UNCTAD's estimates, last year, the assets of sustainability dedicated products amounts to $3.2 trillion, up over 80% from 2019. That shows institutional investors and global markets are channeling, trillions of US dollars have already in stock into sustainable development related areas and sectors. Emerging market, however, to a certain extent, are bypassed bypassed by sustainable development. For example, if we look at the sustainable fund market, developing economies only count for 5% of sustainable funds by number and less than 3% in terms of assets. And although their capital markets account for about 23% of the global market capitalization, this shows that they offers huge potentials for investment for institutional investors, but for whatever reason, they couldn't attract a sufficient investment and benefit from the rapid growth of sustainable investment. Some barriers, include, for example, perceived high risks, and also also the lack of reliable and partners, and maybe also the lack of readily available and projects. So there are many different reasons and barriers for institutional investors, like among the Invesco or other the global institutional investors, to really tap into the opportunities offered by this country. On the other side, in addition to portfolio financial investment, actually developing countries have been important destinations for international investment, and there are huge opportunities there. We all know that now India, for example, is developing the world's largest solar energy projects. They are recycling, many large-scale rubbish, mountains into, useful materials, and these really require a lot of investment and offers a lot of, opportunities. And China, the country we require, trillions of dollars of investment, to achieve, carbon peak by 2030 and carbon neutral by 2060. So in other small economies, similar opportunities are already widespread. So basically, our challenge today is really how to, develop innovative sustainable investment products for institutional investors, and how to make the projects readily available for them, and how to come up, how to provide support and and service for them, like Invest India has been doing in recent years. So today we're very happy to have the experts from the leading institutional investment institutions, especially in the area of sustainable investment with us. And we believe that we can, our discussion today will share a lot of light on these challenges and issues, and will be helpful also for UNCTAD to have a better understanding about the issues and come up with ideas to address these issues and to facilitate sustainable investment, especially in developing countries. Thank you very much.
Thank you, Yongfu. Thank you for those introductory remarks. And for setting a little bit of context, the trends in sustainable investment, which has kind of exploded last year, really. And also thank you for touching on some of the issues that we hopefully will hear more about today, and some of the problems and challenges faced in terms of risk perception, improving risk return profiles, and lack of products you mentioned. Turning to our first speaker, Angela Bai, who's the Secretary General of the China Alliance of Social Value Investment. She has 23 years experience in the finance industry, member of UNDP's SDG Impact Financing Technical Committee, and a director of fund management company Angrameen China. She, I believe, is going to talk a little bit about a product in emerging economy in China, an ETF that they launched, and perhaps can tell us a little bit more about what they did and some of the challenges that they faced and opportunities too. Angela, over to you.
Thank you very much. I'm very honored to join this session, even though this is the last one. But very honored to join this World Investment Forum. Can you hear me clearly?
Yes.
Okay. I would like to share, the case, in China, we call it China Sustainable Development 100 ETF. It's an exchange traded fund. This ETF, we work together with the top mutual fund in China and launched, I think in the high time of the COVID-19, that's January of last year. So up to now, I think it's 22 months. So it's a great case to see what's market performance and also what's the SDGs impact, and also so what challenges we had and what opportunities we ever seized. As the full name is China Alliance for Social Value Investment. It's NGO, and it's NGO dedicated for the researching and development and specializing for promoting this sustainable finance in China. So what we have done over the past 5 years, I think is we started from developing this modeling and how to evaluate this public companies' sustainable development value. And then we generated this ranking list. And then I am working together with the China's Bloomberg, that's WIND, and launched as a research and stock index. And then we were found and pursued by a group of those security as well as mutual funds. Eventually, we selected this Bosara and launched this stock index in Shanghai exchange. So then, this ETF. So this is, very brief about this journey, but let's look at, it's what have happened over the past years, how we can make it happen. I think is the key. KSV is NGO, so we don't have the license to issue stock index, and neither, for this mutual, the fund product license, nor for this stock index. So, however, we would like to bring this SDG, financing dream into reality. And then the only, the option is we have to collaborate with other key players. So look at back to 2019. We, it's just the KSWIS network as we're working together with a lot of experts coming on pro bono basis, coming from the capital market, from the listed companies, as well as the third parties. And then, when we sign up the top fund, Bosara, I think it's the whole game changed. And then, it's the CSI, the China Security Index, joined us, provide us the channel. And then we can, it's selected this constituents. And then it's Bosara. I just do all of this product development. And the three of us seeking the approval from China authority. It's the China Security Regulatory Commission. And then in June 2019, it's a Shanghai Stock Exchange. I think it's they really gave the green light to us. And so starting from that, and Bosara, KSV, we had a roadshow. First stop in New York, Wall Street, and then Amsterdam, and then back to Hong Kong, Macau, Shanghai, and Beijing. So it's around 50 to 60 institutional investors we talked. I am, it's, I think it's according to the memo, it's half of the times we talked about it's what's the capital market in China and what's our projection for such a ETF. But another 50% of the times we are talking about methodology. Why, it's, it's our passive index can well reflect it. It's their performance for sustainable development, and how, does it is mapped with this SDGs. February, it's, we launched this fund. Let's just take a look at what's the market performance over the past month. it's the index, the base time, it's June 30, 2014. That's, as must do, right? If we want to have a stock index followed or pegged, it's by any fund, they have to at least have 5 years back testing period. So the base of this stock index started from the June 30, 2014. And then let's guess, this is a comparison among our China Sustainable Development 100, as well as all of the other major broad-based index. So see, this is a SSEC, this is SSEC 50, and this is a CSI 800, this is CSI 300. Wow, so this is the CSI Sustainable Development 100. In other words, over the past, it's since this 2014 until now, the financial yield of such a stock index is 142.18%. That's surpassing all of the other major broad-based index. So this is very powerful because a lot of institutional investors, mainstream institutional investors in China, they don't believe. They think it's a myth. It's such kind of either ESG based or SDG, packed. It's an index. Their performance can be better than the financial only, or the other thematic index. However, our very solid data show them as this one's continuously, after this 2015, continuously surpassing, all of them. So that's give, I think it's a very solid evidence to this, to China capital market. They mean, it's the public companies, if you do good, do well financially and non-financially, they can go, in the same way. And this is a good part. And, it's not only for that, but drawdown ratio is lower than the other broad-based index, right? There's a turbulence, it's smaller. So it sounds like a great stock index. Despite of that, our IPO size is, it's $220 million US, but up to now, it just shrink to the 28 million US. That means smaller by 8.17 times. Why this? It is before answering that, let's go back to the evaluation methodology. Is why we are. It's SDG mapped, and also it's good enough to reflect this public company's sustainable value. So because the part one is a negative screening, and we have the 6 themes and the 12 indicators, and then moving to the positive scoring. Not only ESG, but also this financial innovation norm is whether their vision, mission, strategy, core business, and the major beneficiary is well, aligned with the SDG goals, and whether their environmental, social, and governance well supported SDGs. So indicators 200 plus. And the last part is impact mapping. So the process, it's it's a long and they need a great hard efforts from the data feeding, data cleansing, modeling, evaluating, analyzing. So among all of them, there's been in order to show to all of those institutional investors, so this is the open box and the transparency. And so we have this transparency challenge. I mean, after generating the whole ranking list, the final constituents, we just bring it to all of the signed up institutional investors, stock exchange, and the index companies. And, it's just to seek their challenge. Any, as long as they raise up their hand to say, And I got a scandal is for any, I know a scandal for any of the company. We're gonna go back to check this scandal, whether it's true or not, and then review the whole data running process and the routine process. And so because we published the blue paper book, and including all of the in-depth researching, analyzing, and for this portfolio, already we have the annual publication for 5 years in a row. So because I'm time conscious, so I just select one page to show how China top listed companies perform in their SDG impact. So this is a SDG goal 1 to 17. And I think it's just a single out of 17 for a while, because the rest of the 16 is more business related. So the blue one means they are social related, and the green one is environmental related. And this orange one is a business profit related. So we find it, this is the undisclosed for this ground one. We found it particularly this environmental or life on the water, the land. It's a lot of Chinese top companies has no mention at all in their report. And then, it's following to that, we don't have any evaluation data for that. The green one is disclosed, but they did not show any SDG mapping. And then this light orange one to say they have this SDG mapping, but without a maturity. They don't give us any the project, the data, and the factual, data to support this SDG mapping. So then we found that China, those top listed companies, they're particularly good for the business-related SDGs goals. And still, it's they're a little bit, it's far away. It's for this 14 or 16. I think it's the average for those people who are social related SDG goals. And also this very, we can see a good turning point. Since the last October, the whole China moved quickly to, the focus on this climate change, because of China's commitment is for the 2030 carbon, it's in the 30-60 for the carbon neutrality. So what we learned from this case, actually we learned a lot, but I just pick up in the few of them. And also this case is open for your insights. The first one, partnership is key. KSW is an anchor player. And without KSW, I think it's perhaps we cannot make this game rolling out. Even though China got a lot of ESG thematic fund, and also all of you know green bond already grow up to the #2 in terms of the size in the world. However, it's this is only one. It's a passive. It's a stock index packed fund. The rest of them, I think, still we call active the fund management, subject to the fund manager's choice. Most of them still benchmarked against broad-based index rather than any sustainable, index or ESG index. So means it's a little bit questionable for whether or not they gave any meaningful, evaluation for them. So partnership is key. KSW play as an anchor player, but we cannot make this happen without our mutual fund and stock index, security index, and the stock exchange, particularly those institutional investors. Among this, the IPO for this ETF, 7 banks, 6 top largest insurance companies, and also it's the fund from Wall Street, and even it's one foundation. The first one, NGO organization, joined this, ETF IPO. So it's So we really make a lot of number ones in China. So and the last one, it's the thematic SDG financing outperformed the non-SDG ones over the 12 months. And the significance grows bigger and bigger over time. So it's before, we're launching this researching, and we learned a lot of exciting, encouraging stories from European market, American market. It's all of the ESG or SDG related this stock index, they outperform this financial only one. But we don't have anything here. But right now, so we have a flagship stock index. However, why this is such a good ETF with a great performance and the size is coming down so quickly from 221 to 20, to 30, 8 times smaller than the IPO. I think the first one is investors come and then go. I think that they're mainly driven by the KPI, even though they love the SDGs. So unless we can find, a very proper incentive scheme, otherwise we cannot keep them for long. Or, so that's why we also have to work very, it's intensively with those pension fund, sovereign wealth fund, because they are more, they're seeking more about the capital's meaning. It's they care more about doing good and doing well. But those the other institutions, even for those insurance companies, the bank, is assets owners, I think it's the same. They're mainly driven by the KPI. It's unless we can engage in more and more investors, otherwise, they're going to go back. So either we have a very big game or no game. So this is the case in China. And also we have to seek in the anchor investors, particularly for the pension fund, social wealth fund. So that's why it's over the past years, we're working very, very hard, with those the anchor investors to, reconcile this methodology and to try to crack up all of the challenges on the journey. So that's all sharing about the case. I'm not sure whether I keep on time. And back to you. Thank you very much.
Thank you, Angela. That was fascinating. Really, really interesting to see that product, that ETF being developed by yourselves, of course, in partnership with others, which, as you point out, was a key factor in your success. Your fellow countrywoman, Yimei Li, as the CEO of China AMC in our session on Monday, she raised a couple of points about some challenges for investors that were difficult. One was the need to raise awareness of these investments in emerging markets, and also to engage a bit more with listed companies to increase their disclosure. And you showed a chart of some companies, especially on the climate metrics that did not disclose. I'm just wondering if you go back to companies, you engage with them yourself, or that's not your focus. You're more oriented towards the attraction of anchor investors and keeping your investment to avoid the outflows that you mentioned as well.
Mm-hmm. This is about the methodology, how we come up this this stock index. This is mainly for the we have the 3 steps.
Hello? Have we lost Angela?
Hello?
Hello, Angela.
Hello?
You're back. You're back. Sorry, I thought we lost you there.
Oh, sorry.
You were
It's
saying.
okay. Where am I going? Okay. Go back. It's I think that we have the 3 steps. The step 1, and one way, just it's mainly a data running. And usually at this stage, we do not contact or connect any our evaluation targets to ensure it's a fair and a transparent evaluation. However, it's after that, is we're gonna select the best one, the worst one in terms of the change, and then have the deep dive. It's a study, it's a case study. But only 50% of them accept our interview request. So it's however, this interview is conducted by a group of the experts and coming from the capital market, security, the fund managers, and also the academic and NGOs. So, and also some experts from different industries. It depends on which business such a company in. And then the step one, step two, this is step two. The step three, and we then go back to do their SDG impact, its analysis. So we are, keep on searching for the better methodology and how it can improve the transparency. To make sure, and up to now, I think it's I have the same concern with all of my peers in the world, and whether data have the materiality, and also whether they are true or not. So that's why now we just try to broaden our data sourcing, and also try to seek the help from alternative data. Something like this sensor-based this data, try to track those companies' ESG as well as the other indicators, is in more accurate way.
Yeah. I mean, I think that's a problem for all of us, and we ourselves in UNCTAD are working on a methodology to try and assess impact on the SDGs and contributions to SDG sectors or themes. I know other speakers here, perhaps Glenn has a view on data sources and methodology and accuracy and the credibility of some of these sources. Yeah, perhaps Yongfu, I don't know if Yongfu or the other speakers have a question they want to jump in at this point. No? Oh. Yongfu, you're muted.
Thank you, Jenna, for sharing with us this very interesting product. Actually, I have two questions for you. One, I can see that you try to to involve international institutional investors in the process of IPO, and also as the investors at the current stage. So I would like to know, I would expect that this product can be very interesting for them. But at the same time, they may also have some concerns for, before they can put the capital in your products. So I would like to know what could be the concerns, and how partner like your association can help address it. This is my first question. And the second one is you raised the data concern. And I know that you are you are a pioneer in this area in the Chinese market, but but I don't think the data issues can be addressed by a single institution. So what do you think will be the best way to address the data issues in the market? Thank you.
Thank you very much, Yongfu, for your question. You just reminded me I'm missing a very important page. Right, it's over the whole journey. Actually, it's a lot of institutional partners, including of those banks, the Manhattan banks, this Coward Fund. It's including of our United Nations different agencies give us a lot of support. Mainly, for two things. One is for the methodology. Another one is try to, refer the institutional investors to us. So I think I owe them a very, very heartful, as appreciation to all of them. And for your second question, data challenge, I think it's Rome cannot be built over one night. So we have to, address it step by step. However, I firmly believe that the power of technology is currently we are building a data pool, and by collaborating with the different, the data service providers as well as the other some association and the ESG researching centers, something. We try to align them and forming up it's a collaboration network for data. This is one thing we call it data 1.0. And data 2.0, we are talking with the government to see they have the authorities and the different authorities, for example, the production security, the environment and the climate, the ministry, all of them have a great deal of the data can be very useful to us. So we're talking with them, it's whether they can make part of their data available. It's to support us. Maybe we do some, the data encryption, something like that. However, they're going to be very powerful to support our cross-checking. In data 3.0, I think that is something I mentioned is the alternative data. I mean, eventually we have to rely on some data cannot be changed by anyone. I think it's to generate a final rating. That I think will be those satellite sensor-based data, or as well as the GPS-based data, those pollution sensor. It's the transmission data. So this something that's why we're working with a lot of technology players and try to resolve that. And also, we really look forward to those international partners joining us. And also, we would like to open all of this methodology or, our, the bittersweet things. And then to see perhaps we can inspire each other. It's for the same SDG goals. I hope I answered your question.
Yes. Thank you very much. And I think, because we have the luxury to also have Caroline and also Glenn from the, the Western asset managers here. So it would be interesting if you have any comments, on their product, and if you, or do you see any opportunities for example, for collaborations around the data issues, with Indigenous Association?
Sure.
It would be interesting to hear you.
I'm really happy. I will sit through the whole session, and I think I'm all ears for their presentation. And okay, I think after their presentation, I really would like to see how we can work together. It's perhaps after their introduction.
Okay, great. Well, in that case, we should move on. I think because time is pressing. I think we're going to now turn to Noelle Tan, who is senior client professional and deputy member of PG Life Impact Committee at Partners Group. She formerly worked for JP Morgan, Credit Suisse, and in her daily work, she's focused a lot on sovereign wealth funds, public pension funds, and other large institutional investors and investments in Asia. And of course, PG Life is, Partners Group is very much it's a private investment, private equity. And here, I think Noelle is going to give us a little bit of insight into a particular strategy, a particular investment that they worked on called Unity. So, and Noelle, over to you. Thank you very much.
Thanks, Joseph, for that introduction. Could I just check if you can see my screen?
It says you've started sharing. I don't see an image yet.
Oh, can you see it? No? Are you able to see my screen now?
No.
It says you're sharing, but I can't see it.
You have started sharing, but we don't see your presentation.
Yeah, let me try that again one more time. Could you see it now?
Oh, no. So maybe we have your presentation. Maybe we put it on the screen for you.
Yes, that would be very helpful. Thank you for that.
Okay,
Yes,
one second.
it worked during the dry run.
Yeah. Often the case. Okay, let me try and do this. Does everybody see that?
Yeah.
I can see it.
Okay, great.
Great. I think
So
we could just on that slide.
Just let me know when you want to change a slide.
Okay, great.
Okay.
Thank you so much, Joseph. And thank you, Yongfu, as well for having me here. Very honored and excited to share more about how we approach sustainable investing from the perspective of a private markets investment manager. For those who may not be as familiar with Partners Group, we are a Swiss headquartered private equity firm with over 120 billion in AUM. And we invest across all asset classes in private markets. So this is private equity, private infrastructure, real estate, and private credit. In my role, I'm responsible for managing our client relationships with sovereign wealth funds, pensions, and institutional investors across Asia. And additionally, as Joseph mentioned, I serve as a Deputy Impact Committee member of PG Life, which is our firm's inaugural 500 million impact at scale sustainable investment fund, which will invest in private equity and private infrastructure opportunities in support of the UN Sustainable Development Goals. And I would say today's topic on sustainable investing is one that is very relevant to us, given responsible investing is very much at the core of Partners Group's DNA, really, where we were one of the first private market investors to sign the UNPRI back in 2008. And for today's session, I would like to share more about our journey as a global investor seeking to scale up our sustainable investments, not only in developed markets, but opportunistically in emerging markets as well. I also want to share how large institutional investors like sovereign wealth funds and pensions think about sustainable investing and how that has really guided our investment strategy in the space. And I will round off by sharing a case study of an investment that PG Life recently made in the Philippines, which supports our thesis. So let me start with our impact investment journey, which began over a decade ago, back in 2006, where we launched small impact investing vehicles that were really targeting more niche, smaller scale investments. But by 2018, driven by the demand we were noticing from larger institutional investors, such as your pension funds, for sustainable investment products, we launched PG Life, our impact at scale strategy that will target companies actively supporting the UN SDGs. And I would say that in designing this strategy and seeking feedback through our network of over 1,000 institutional LPs or investors, we really learned a tremendous amount in terms of how these institutional investors view impact investing and key aspects that had to be addressed in order to really mainstream and scale impact investing across this particular type of institutional investor who may not necessarily invest in much smaller impact funds that may do 50,000 or 100,000 equity check sizes in developing markets, right? Because here they have a minimum investment bite size that they need to meet in order to even take the potential investment opportunity to their investment committees. So the key recurring theme that arose was really risk management. And what we realized was that traditional barriers that institutional investors face include small fund sizes and limited investment scope, which exceed their risk appetite. So instead, what we realized that they were seeking is institutionalized risk, which can be sought through large and proven platforms, global deal flow, and really diversification across asset classes, regions, and sectors. And on top of this, none of them wanted to compromise on financial returns. So the commercial thesis of each investment had to be very strong. So in this regard, while naturally most opportunities will tend to fall within developed markets, there are indeed high quality, impactful investment opportunities in emerging markets as well. And today I'd like to share more about Unity Digital Infrastructure, Unity for short, which is a wireless telecommunications infrastructure platform in the Philippines that Partners Group invested alongside JV partner Aboitiz Group, which is a publicly listed local conglomerate in Philippines in Q2 of this year. And through this partnership, Unity will build and acquire over 7,300 towers by 2026 to address the tower pole demand in the Philippines market. So I think on the backdrop of Philippines' social, economic, and regulatory landscape, we saw this investment both as a compelling commercial case, as well as a great opportunity to positively contribute to the infrastructure required to increase access to internet in the Philippines, which aligns with SDG 9. So maybe just to very quickly shed some light on the attractive backdrop we identified, which was very important for our commercial IC. For one, Philippines is a large population, right? It has in excess of 100 million people, and it's great to have a deep user base, especially for the telco thematic. And because Philippines is culturally social with a young demographic, the country often tops global surveys of internet usage. For example, the average Filipino spends around 10 hours a day on the internet, which is a very high enough figure against a global average of 7 hours. So in stark contrast, the level of investment into tower infrastructure had been constrained due in part to a lazy duopoly of mobile network operators. But this all changed over the course of 2020 when the government really targeted poor phone service levels and backed up its conviction by inviting competition into the mobile phone operator market through issuing a third national operating license. I mean, in short, from a commercial perspective, the investment opportunity proved itself to be viable despite its emerging market risk profile. So now just shifting gears a little bit, in order for this opportunity to qualify for our Sustainable Investment Fund PG Life, the impact thesis has to be well defined and approved by our PG Life Impact Committee, so that there is a robust impact methodology in place to measure the contribution the opportunity is making towards a particular SDG. So using the slides, I would just like to elaborate a little bit on that. So the first would be the impact logic model, which you see on the screen right now, where we strive to link the company's products and services to an SDG target. So by connecting the company's outputs to positive or negative outcomes for society or the environment. So in the case of Unity, it was clear that the investment will provide an increased provision of infrastructure to improve the quality and affordability of internet access, which would play an important role in empowering and fostering social and economic inclusion across the population. So we saw a strong direct impact on SDG 9 and 10. In the impact logic model, we also try to map out potential negative impacts on SDGs and then have a discussion within the impact committee on how, if we were to pursue this investment opportunity, how we could mitigate that going forward. I think if you just move on to the next slide just outlines the next slide. That's the slide. The next slide just highlights the main SDG we focused on, which was SDG 9C. I mean, all the SDGs are really interconnected. So we would also, by extension, find indirect positive contributions to other SDGs. But for efficiency's sake, we choose to focus on the SDG that will be most significantly positively impacted on it. So secondly, after the logic model, if you just scroll down, I think 2 more slides. After the logic model, we conduct an impact assessment to measure how significant the impact will be on the SDG. So in this process, we use the globally recognized IMP framework, the Investment Management Project framework, which I believe my fellow panelists here will be familiar with, which measures impact according to 5 main dimensions. The first would be the what. So this really measures the SDG related impact and how important they are in a target country or region. In Unity's case, the SDG target is high priority in the Philippines. The second would be how much. So how significant the impact would likely be, how many people will benefit from the product or service, how long the impact would last for. And in the case of Unity, the opportunity scored high on this dimension, given Unity's services will enable, firstly, more people to move from 2G and 3G internet to 4G internet. Secondly, it will benefit close to 15% of the total national population. And thirdly, the towers have an expected operational life of over 20 years, a long time. The third would be the who. So who will experience the impact and how underserved they are they with respect to the SDG targets? So in the case of Unity, I mean, the investment opportunity scored the highest rating of 5 on the basis that 100% of Unity's operations are expected to be in underserved regions. The next I mentioned is the contribution. So here we measure the expertise that us as a manager brings to the investment. I think this is an important point to make in the context of us as a private market investor, because as a control investor, Partners Group will have full joint control with our voices, which gives us the confidence to really execute the business plan well. So I mean, if we were to map out a value creation plan and basically have impact KPIs that we want management to actually track, we can go to the board and tell them that they need to, I mean, they do have to do this. We're serious about it contributing to the impact. And importantly, as the towerco industry is heavily regulated, having a local partner to us as a Swiss private market manager is very crucial to the success of the business. I would say that the last dimension will be the risk. So this is really the risk that the said impact won't be achieved. This could include delays due to COVID or potential corruption risk, which is something that our investment committee highly scrutinizes, especially when we evaluate investments in emerging markets. Moving on to the next slide, I would say the last part of our impact measurement process is really identifying the impact KPIs in order to quantify and track the progress on the impact created, or to identify potential areas of improvement. So in the case of Unity, some of the core metrics include the number of towers built, broken down by region, or the number of end users on 4G and 5G. For example, more people should be on 4G and 5G internet if more towers are built, etc. And thirdly, prices charged to end users of mobile internet networks, for example. So in summary, I would say this 3-step process I described is performed on every investment opportunity that we evaluate for our Sustainable Investment Fund Partners Group Live, which to date, I mean, we closed the fund a year ago, and to date, we already have 15 investments in the fund. And ultimately, we believe that sustainable investing needs to start with intention, and just as how we would quantify financial returns in traditional investment programs, we do think it's equally important to have a very clear and systematic approach to ESG or SDG integration or impact measurement throughout the investment process. So from due diligence and investment selection to ownership and then through to exit. So I do hope this case study, provides you a better idea of how we evaluate all these investments that are considered for PG Life. Which, I mean, I'm very happy to share that the fund is tracking very well. I mean, to date, the gross returns are basically in the north of 20% gross IRR. We have deployed a very globally diversified portfolio across infrastructure and private equity, and we expect to raise the next iteration of the PG Life Fund sometime in the second half of next year. So with that, I'm happy to answer any questions that you may have on the fund, or how we approach sustainable investing.
Great, thank you very much, Noelle. That was fascinating. I mean, really, really interesting to see a investment there in a core SDG sector in infrastructure, very important for the SDGs, and especially connectivity and telecoms as well. You mentioned at the beginning that these investments at PG Life are demand-driven. They have been since 2006. And I just was interested to know whether that demand is not just for sustainable investments, but also perhaps for a greater exposure to markets like the Philippines or other emerging economies.
I would say that there has been, I would say it really depends on the institutional investor that you are talking to. I think we do encounter some investors who only want developed markets exposure, but increasingly so, I would say, with large Asian sovereign wealth funds and pensions, We do see a growing demand for increased exposure into emerging markets like the Philippines. I think ultimately when we look at investments in emerging markets, it's about whether we can get comfortable with like the regulatory frameworks, the corruption risk, whether at the end of the day, from a return risk standpoint, on a relative value, we were to compare that investment across similar investments across the globe, it stacks up, well or even better. And I do see a trend towards those markets like Philippines, Vietnam, India for sure, and China. Yeah, I would say China is almost. I mean, some people say it's basically a developed market now. So I mean, that's debatable. Yeah.
Yeah, that's interesting to hear as well that the demand is coming perhaps from within the Asian region. I know that certainly in some markets in Europe and elsewhere, there are fiduciary rules that perhaps prevent some institutional investors from having exposure or too much exposure to some of these markets. So perhaps investors in the region are leading the way and showing that it can be done. Are there any of the other panelists have anything to add to this or questions to ask Noelle before we move on?
I think I'd like to ask a quick question from Noelle. No, I think excellent presentation. I think and I think a great investment case as well. I just wanted to understand, when you're looking at global LPs, global sovereigns and pensions, is there any regional disparity on how LPs are thinking about ESG? And are they trying to define ESG differently when you're looking at, say you Middle Eastern sovereign versus North American pensions? How are they really, looking at ESG? Or do you think there are any regions which are yet to take up ESG in this manner?
Yeah, I think Rahul, thanks for the question, and I think you are spot on in your analysis of different LPs globally being at very different stages of their understanding and implementation of ESG, right? I mean, I was very much involved in the launch of PG Life One. We did a global roadshow. And I mean, I would say that the European LPs are definitely far ahead, I mean, of many of the Asian LPs, right? I mean, even if you were to look at some of the most sophisticated Asian LPs in the region, in Singapore, in Korea, I would say that they are still, quite far behind the sophistication levels of the European pensions and the corporates. But I would say that today, I mean, at least over the span of the last year or so, I mean, we have been getting a lot of inbound requests on ESG and SDG and sustainable investment strategies. I mean, I would say we probably get one a day. And these are not just from your family offices or small pension. These are from, your large pensions and sovereigns. I think it's a very good sign because they tend to be the market movers when they make an investment in a sustainable investment fund. The smaller pensions, the corporate pensions, that the university endowments, they all tend to follow. So I would say the tide is shifting, right? Yeah, I hope that answers your question.
I don't see any other hands up. Does anybody else have anything they want to add? Sorry, Rahul, did you want to come back on that? Okay, well, thank you very much, Noelle. I know you have to leave us, but thank you for staying out. It's late in Singapore, so very grateful for you having joined us. We're now going to move on to Rahul, and I think it's a good moment to do that. It's a good link between an investment that Noelle was talking about and the kind of direct investment that Rahul, you are targeting in India. So slightly different focus, but also targeting institutional investors in a very very dynamic market. Rahul, let me just say a couple of words. You're the head of institutional investment and senior vice president at Invest India, and you have a history working for the Bank of America Merrill Lynch on institutional derivatives, and currently you do a lot of work with SWIFT's pension funds and also private equity. And you're, as I said at the beginning, you sit in the middle of this session today on the demand side. So it'll be really interesting now to hear some of your experiences and perspectives of attracting the investment that we've been talking about. Over to you. Thank you.
Sure. Thanks so much, Joseph. I think it's my pleasure to be at this panel, and thank you so much for inviting us to share our views. I think 5 years or 6 years back when Invest India, really was taking shape, and I was given this responsibility to go and speak with SWFs and pensions. I think wherever we went, everybody said, give us opportunities and we'll give you money, right? We'll invest money if there is opportunity. And and it really was an issue, right? So, right, emerging markets have varied sizes, and even a country of size of India could not offer a lot of deals 6-7 years back to these guys. They wanted to have a check of $200 million in one go, that even minority, and it was very difficult. So 5 years back, that was our thought process, and we thought I think if we have to get that big money in India, in sectors which can impact jobs, which can it can really get the real change on ground. We need to create policies. We need to create asset classes where this money can come and change the game for us. And as an IPA, I think we took that challenge and we started working on that objective. And when Yongfu said when in his opening remarks that global FDI fell in last year, in India it was different. In India we actually saw a 13% increase. Right, and one of the reasons, a very strong reason, is that I believe is the capacity which we could create for global investors to invest in India. So I'll start from there. I'll try and touch 2 or 3 sectors where we've tried to make that change and we could attract capital, and just share what we are really doing. But one thing I want to start from, I think a few months back, our Honorable Prime Minister was doing a session with institutional investors, and he made this statement, this beautiful statement. He said, India believes in following the path of growth with equal focus on ESG. So the recognition of ESG in India is now coming from the highest level. And when Noelle said that they're looking for returns alongside sustainability, that's exactly what we are trying to offer to the global investors when they are coming to India. I think so, being an IPA, I think there are a lot of things which we've tried to do, increase the growth rate within India, have the right ecosystem. And I think one point I want to touch here, but rather 2 points, is the internet users and the global fintech adoption. I think what we've tried to do is create that ecosystem from a policy standpoint where fintech can be adopted. So we create this beautiful system known as UPI in India, unique payment interface, where anyone can actually use their mobile phones to make a payment. So what we call is a billion. So we call it a trinity, which we have done. So we have 1 billion mobile phones, 1 billion unique IDs, and 1 billion bank accounts. So we created that infrastructure. On top of that infrastructure, we created this UPI. And then we allowed it to, go out. So today, if you go and, you want to do a 2-cent transaction on a roadside vendor, that vendor is accepting fintech payments from you. And that's this UPI. Just to share a quick number there, we did 3.65 billion UPI transactions last year. So, a country of 1.5 billion people is doing that large transaction amount. Tells you how it's changing and how that change impacts people on ground. So, just a quick case, quick personal example. I started a venture, 8 years back, and I had to shut it down because I could not accept cash payments. It was very difficult to return change. And suddenly all of that is over, and doing business in India became very, very easy. From there to growth, I think that leads to, how we are really doing things. India has grown phenomenally. The first trillion took 63 years. The second one took 7 years. Third one took 3 years. And now we are moving towards the top 3 of global GDP ranking by 2030. We should be between 8 to 9 trillion. Our target is to go to 10, but that's what we're really going towards. What's really going to happen, right? And how India is changing. I think that India has huge population. So, if you have to, and when you give jobs to those people, when you give, when you increase the wealth there, that's where, the real game change, it's the real game changer for global economy as well. Just to compare, if you see a chart on the left, which is 2016, it tells you the affluence in tier 2, 3, and 4 cities of India, most of the names you wouldn't know. It is going to change from what it is on the left to what it is on the right by 2025. And it's, very interestingly, I think most people only know Delhi, Mumbai, Chennai, and Bangalore in India. But the smaller cities actually, are the consumption hubs, and where, most Mercedes sales or Amazon sales are happening there. Large, and, I think we all know India is a huge population and will be the population, the workforce for the world. For the next 10 years, we will add 114 million people for this workforce. India will be contributing 20% of the global working population by 2030. And it's important to actually employ these people, because these are the ones who are going to add to global GDP, global growth. And that's what we are really working on. So I'm just bringing back to the point which I said earlier, creating opportunities. So using this as a resource which we had, we launched multiple initiatives. And, so for a few years, we have worked really hard to add to the science and engineering graduates. We are in fact #1 in adding those graduates in India. We had about 900,000 graduates every year. And that has led to India becoming the R&D hub for most major companies. So we have most R&D centers today. I've taken one case study of the healthcare example, where some of the most global R&D which is happening, whether it's the GE Edison or Siemens or Philips, we've been doing path-breaking work in India for such initiatives. Startup is very, very critical. I think our Prime Minister launched this initiative so that people can, entrepreneurs can create jobs, and we've done wonderfully well. Startup India is part of Invest India. Currently we have about 52,000 startups registered, which is a 7x growth from where we were, about 10 years back. We've raised about $63 billion, and unicorns are just flowing. I think last quarter we raised more than $10.2 billion, and we created about 8 unicorns in just the last quarter. We were only second to the United States in creating unicorns. I think I just want to take a small pause here and to share this, the impact of this on Indian economy actually. So BCG did a report recently, and they said that the gig economy which these startups have created can create 90 million jobs in India. We have already created close to 24 million. We will go up to 90 million jobs and change the complete landscape. So the impact which this capital is creating is enormous in India. The second one is about renewable energy. We are still, among the low-income countries, but what we've decided is to cut on emissions and cut on emissions massively. So renewable energy is what we are picking up. We've already hit 100 gigawatt of renewable energy. So again, bringing back what I said earlier, on this 100 gigawatt of renewable energy which government has created, what we have done is we have invited institutional investors globally and startups locally to create capacities and value for the world. We are now moving to 500 gigawatt capacity in next 10 years, while having manufacturing of these solar panels, the wind blades locally as well. So that's how the entire thing is changing. Sometimes it gets difficult to understand, but if you're in a far-flung village where you've never seen electricity and you get that electricity, actually at that point you can use the fintech, that phone, then and fintech and e-governance can only reach you when you do all of those things. And then on top of that, we've done universal healthcare, which is creating huge number of opportunities for global investors, the likes of many who are on the panel today. Electricity to all and housing. We are doing today. We are doing everything for all, right? Not for a certain section of people in India. This creates returns. I think Noelle mentioned that you need returns, right? And that's a very, very interesting thing in India. If you really look at that number, 34%. So Indian the return on capital employed for Indian arms of MNCs is 34%, where for the same global companies is 15%. That difference, that spread tells you why it's attractive, why we grew by 13% last year in the pandemic as well. Why that happened? Ease of doing business, one of the most critical aspects of us. We were focused completely towards making it easy. Whether it's a small entrepreneur or a large enterprise, we wanted these guys to have a good experience while they invest in India. Invest India was one such example, and we became world's most awarded IPA because of those reasons. Innovation was the focus area. We grew there, as well as giving better logistics services to businesses to perform in India. In summary, huge opportunities for investors. So as I said, started with that, you have to give opportunities for investors to invest. So that's what we are really offering. Across sectors, you can come, you can add, you can invest in those sectors and definitely reap returns out of it. Is what is on offer for investors. This is, I think I spoke about it, so I won't get into it. But quickly, for emerging economies, I want to share our strategy. I think today we are working on 3 different levels for institutional investors and the to bring that capital into India. At the first level, where we want to bring large capital, the focus was on creating models which did not exist, where that large, big patient capital can come into India. We started asset monetization, asset recycling in India, where we started with highways and we did airports, and now we have come up with national monetization pipeline of about $100 billion, where we attract capital to contribute from pensions and sovereigns. The second one was startups. I think that was very critical. Invest India, nurtures, facilitates startups, and within that, that entire Startup India platform, we do that bit, and we also train entrepreneurs. We train people to become entrepreneurs. So all of that activity is part of Invest India. And last, and one of the most recent, initiatives of Invest India is commercialization. Helping innovators to become businesses. We call it Agni, the Accelerated Growth for New India Innovations initiative, where we work on innovations and convert them into businesses, and not only local businesses, but global businesses, which can help countries like India, of course, and then emerging markets which are coming like that. Fintech is a beautiful example there, with which multiple countries already are benefiting from India's example. So that's our strategy, and it has led to phenomenal change in institutional investments. We used to average about $10-12 billion of private equity institutional investments back in 2010 to 2014 period, and last year we clocked $62 billion. So completely, it has completely changed, and we believe this is just the beginning, and we are going to do far more. This is us in the Investment Promotion Agency of India. Very happy to work with any investor who want to come into India. We give them entire end-to-end handholding and work with them to have a successful life in India. Thank you so much.
Thank you, Rahul. That was a very convincing pitch for investment in India. It's so often you hear this term bankable projects, which of course is one of the sort of core jobs of investment promotion agencies like yourself. But I mean, what you were showing us, there's plenty of opportunities. And I'm just wondering if any of the other speakers, Yongfu, I know you have a background in investment promotion, or some of the other speakers, if they want to ask, chip in here and ask a question.
Hi, Rahul, thank you very much for sharing. It's great. I think that here there's so much amazing achievements made by India. Two quick questions. First one is, what about the ESG or SDG investment penetration in your total investment portfolio? In China, it's not an encouraging figure at all. I think it's currently still around 1%. So that's why we're working very hard day and night. And what about the percentage in India? Another one is, I heard a lot of great stories about fintech, how to leverage this NI, to support ESG investment, SDG data running. What about it's whether or not it's those NLP, the natural language processing technology applied for those data running. That's a necessary things for this SDG measurement or ESG rating. Okay. Thank you very much in advance.
Thanks so much. Can you repeat your second question once again, actually, if you don't mind?
Second question, it's it's particularly strong in India about fintech, right? Particularly for those NLP, natural language processing, AI technology to support this data running. What about in your, it's reader screening, and could you give me one or two case to show it's whether or not it's they are doing the great things, to leverage the AI, technology to support SDG measurement or ESG rating? Because this is something we are working on in China at current stage. So, yeah.
Sure, thank you so much. I think I'll start with the first one. Honestly, I think in India, I think we are yet to classify investments as SDG or ESG investment. I think the bigger problem there is classifying investments as ESG investments. And that is why arriving at numbers become difficult. If I honestly, I think if you really look at 63 billion, 62 billion, which I mentioned just now, a huge portion of it, and I should say about 70%, went into infrastructure, connectivity, healthcare, edutech, health tech, so on and so forth. So most of that money is going there. But arriving at, really arriving at a SDG number, which you said, for instance, 1% in China, that number we are yet to, we are not able to yet arrive there. So, I'm sure the same challenge exists in China as well, right? You realize, you are creating a PPP road, which is reaching a village, changing the lifestyle there, but you've not been able to classify that as ESG investment. So that's, I feel that's the bigger challenge. But I think we started to do that. On an impact front, I think we've done more than $1.2 billion investments. But these are pure impact, right? Small scale hospitals, clinics, things like that. So that classification is what I would blame right now, and probably in another couple of years I'll have better answer on exactly how much percentage we are doing. The second one there is very interesting on how we are able to, I'll tell you my understanding there. India has multiple languages. How we are actually able to integrate that entire thing using one phone and really do that fintech. In India, the adoption rate for fintech is 87%. So a huge population is actually being able to use fintech, and I think I would I'm not sure of the technology on the national on NLP, but people are able to use phones in their in their local languages, are able to make those payments in local languages, including my father, who does not prefer to use English while he can. Comfortably and able to make those payments using the same phenomena. So that has happened, and startups have done that beautifully in India.
Thank you, Rahul, and thank you so much for the presentation. We're running a little bit behind time, so I'm going to actually quickly move on now to our next speaker, Caroline Lemot. Excuse my pronunciation. She's the head of ESG research and engagement at Amundi. She's previously head of long-term investment at the pension division of Caisse des Dépôts in France, and formerly worked for BNP Paribas. She's going to present, I understand, a little bit of Amundi's ESG product line, and tell us a little bit more about how they integrate ESG and sustainability perspectives and concerns across their investment process. So Caroline, over to you. Thank you very much.
Yeah, hello everybody. I'm glad to speak to you today. Just I wanted to present you how we include ESG in our product line, but also in the way we are investing in many companies and in emerging markets in particular. So I mean the ESG journey has been quite long for Amundi, and we are really accelerating over the last year, where we take into account ESG when investing in all our open-end funds. Just I mean, to more precisely, why we take into ESG is because we truly believe that for the sake of our clients, it's really important to promote a transition towards a more sustainable and inclusive low carbon economy is the right path to make sure that the growth will be sustainable and not hectic somehow. And for that, what we have been doing is integrate ESG KPIs in all our portfolios, portfolio constructions, and also accelerate on our engagement and policy. And this cover obviously the developed market, but also the already emerged called emerging markets, because we truly believe that it's something so important that it should cover all our investments. So we have some capabilities. We have more than 40 people focusing on ESG in our ESG business line, but we are like a kind of expert center for the fund manager across the globe. We have our own ESG score covering more than 12,000 issuers, including emerging market, of course, and we have a different policy. What is very important that is, and I think, so our Angela was mentioning it, is that it's true that if we want to push the SDG agenda or the ESG agenda, disclosure from the issuers is key, because as you can see here, we are using ESG data, ESG KPIs to have a ESG score, which is used to assess the ESG quality of the company we're invested in. So engaging with the emerging market issuers to push them to disclose more information is key, because we truly believe that in Asia, in most emerging countries, issuers are doing already things, but maybe they don't disclose it. And there is a kind of discrepancy in the world between Europe-based issuers, where the regulation makes disclosure compulsory. So we have a lot of information compared to other markets where the regulation is less demanding in terms of disclosure. And it won't be wrong to think it's because there is less disclosure, the company are not doing the job. It might be so, but it also, we have many cases where the company are doing things. It's just that we don't exactly know, and they don't have clear targets. And I think part of our journey, emerging market ESG journey, is also to dialogue with those companies in order to explain them what we need as an ESG investors, what kind of KPIs we need and what kind of disclosure we need. So as you see, we are doing this ESG score on a monthly basis. And what is really important is we are doing a lot of engagement, because we think is when you are speaking about listed assets, having some very advanced engagement policy or CWAT policy is very important to cover SDGs and have a real life impact. So we are engaging on climate, obviously, but I mean also in biodiversity laws, natural capital preservation. Social cohesion is something important for even for long-term growth. The client's responsibility is also important, and governance. Why? Because even working around strong governance, business ethics is really key also for long-term growth. In terms of product offering, so we are truly believe that across, I mean, we can really have some very good investment product in emerging market countries. But on the top of that, we have several initiatives to not create, but improve the market, especially around green bonds, where we had several initiatives to create emerging market oriented green bonds and other products. The thing is, what we are doing with our clients, so we are trying to have some investment solution, but we also, whenever they need, we engage a lot with our clients, have a dialogue with them to help them having their own investment policy with some ESG embedded. We offer some training because we truly think that we are part of a global ecosystem, and by dialoguing with our clients, our peers, it will make the whole market going to the right directions. And we do also some advising work for some of our clients. So out of the 1,008 billion assets under management from Amundi, almost 8 billion are already ESG, and we are still pushing forward the work. And then in terms of offering, it's true that we are trying to have an offering, ESG offering, which is cover the global spectrum of asset classes. And to answer to Yongfu, we truly believe that there's no reason why we couldn't have some great ESG emerging investments. And we are deeply convinced that we need to fight these views that to be ESG, you just have to be exposed to the development market. We really think that on the contrary, there is first need to huge investments for the climate, but also for different SDG in emerging markets. Secondly is good investments and a good ESG as well. This is for me, for the six. I think we need also to have time for our fellow from Invesco.
Caroline, thank you so much. That was really fascinating and really interesting to hear how Amundi is really committed to this across all of their investments. It was a message that we had in UNCTAD's World Investment Report this year, of really talking about the transition of sustainable investment market from a market niche to market norm, and really making this a standard practice. As you say, we are very tight on time. I've extended the stream so we can continue for a little bit longer. I don't know if anybody else wants to just ask a quick question to Amundi before we move on to Glenn from Invesco. There's Angela has her hand up. Angela, would you like to say something?
Yeah, Caroline. Just now I mentioned that you have the proprietary ESG rating, and also it's you have the monthly update and around 12,500 of ESG rated issuers rated. So I would like to know, it means a very, very big commitment and also a big budget to support that. And yeah, I'm really wondering whether all of this rating only for your internal use, or also you would like to share with others, and also how, as an asset manager, and how does Amundi to see external rating?
Okay, so we use several data providers to compile and have our ESG score. So our value added is in selecting the best data provider and combine them according, because we truly believe that there is value in all of them, and it's by choosing the right KPIs where we think they are better, then we will end up having our good ESG score. And we are always open to add some new data provider, always to enlarge our coverage to improve our scoring, it's true that ESG means a little bit of budget because it's assessment of some new angles compared to accounting only assessment, and to be thorough. We really need to have a lot of data, a lot of human power also to assess the issues, but also the theme. So yes, it's costly.
Thank you very much.
Phil, I see you also have your hand up.
Yes, I have one other question for Caroline. So I'm just wondering, because AM, the Amundi, has is one of the biggest asset managers in the world, and you have a huge portfolio to manage, and you are heading the engagement basically in the company. I just wonder, when you communicate or engage with your investee companies, what kind of tools you use to engage them? You do survey regularly with them, or I just want to have to know more about your engagement the program.
It will depend. We will have different level of engagement stream. We have some engagement stream which are global to the exposure. For example, on coal phase out, which is a theme which is really important for us because we think it's key for climate. We will engage all the company we are invested in that are exposed to coal. So it's a global engagement, and we will do at least once a year per issuers, and sometimes several times a year. And after, we would choose some theme where we think we want to push like a circular economy, for example, or biodiversity loss or deforestation. And we will choose a subset of issuers we are invested in, and on those themes, we will engage them for 1 to 2 times a year during like around 3 years. The other topic, sometimes we can engage on controversies many times a year on something very specific. Unfortunately, some issuers with multiple exposure might be engaged several times a year also. And on the emerging market in particular, we have an engagement stream which is specific on, for example, disclosure, because as I said, we think a lot of companies have good practices, but just don't disclose it. And for that, we are usually engaging at least once a year for them. And how we do that is the ESG team is doing it directly, but also we team up with our numerous fund manager and financial analysts to do so. And we have an internal tool to follow all the results.
Okay, thank you.
Thank you very much, Caroline, and thank you for your interesting presentation. I know that myself and Yongfu will probably be following up with all of you, in fact, with further questions that we have and perhaps areas of collaboration. This brings us to our final speaker, Glenn Yelton. Glenn is the head of ESG client strategies at North America, Invesco. Before working for Invesco, Glenn had experience developing ESG and impact strategies, as well as a background in developing research tools and measurement tools for ESG impact and performance. So Glenn, without further ado, I hand over to you, and I look forward to your comments today, both on Invesco's work and perhaps if you had some reaction to previous speakers. Thank you.
Thank you, Joseph, and thank you, Yongfu, for having me here today. It's always interesting being the last speaker in a presentation like this, because there's such great material that's presented before, and a lot of the questions that the audience may have about the topic have already been addressed. And today's presentation, actually following Amundi, is great for me, because I don't have to cover a lot of the basics, because Amundi is world-class in the way that they're looking at ESG and ESG integration. Pivoting to Invesco, though, I do want to share a couple of things about what we're doing whenever it comes to sustainable investing in emerging markets. This is an area where To be honest, we don't have a lot of explicit strategies that are labeled as ESG or labeled as sustainable in the space, but it is part of our market allocation where we are actively looking at ESG factors across all the portfolios there in our emerging market debt, in our private placements, and in our equity investments, particularly in our innovation suite that's focused on emerging and developing markets. And for us, there are a couple of key themes that come out with this type of an allocation in this sector. We've talked a bit about it during previous panels, but previous parts of this panel, I did want to highlight that opportunity is a huge component of what makes emerging market investing interesting for Invesco and for our investors. The opportunities there are almost limitless. Rahul's presentation just on India alone highlighted how many new businesses are being created, the technology advancement that we've seen in fintech in that space, just that overall prevalence and change that's being driven. And for investors, even non-ESG, non-sustainable investors, that opportunity is critical. And also that opportunity is partnered with innovation. Emerging and developing markets are where innovation is happening. We often think about Silicon Valley and Facebook and Tesla as you know, the way that we're changing the world. But the reality is that innovation also happens in incremental ways. And those incremental ways often happen in markets that are a little bit more resource constrained, or where the infrastructure is not the same as a developed market. And so innovation and opportunity there hand in hand lead to great investment opportunities and ways for us to allocate capital into those particular markets. We have spoken a little bit about risk, and there is a high level of concern, particularly in developed market investors who are a little bit less globally oriented whenever they consider risk in emerging markets. And part of what we work on is understanding and being aware of the risks in the allocations that we're making into these markets, and understanding how those risks can be mitigated. And that mitigation occurs through evaluation of good governance practices of the firms themselves, understanding the regulatory environment and the changes, but evaluating the policies, the programs, and the performance of the companies that we're investing in. But that risk is also addressed through allocation and how we can allocate across emerging markets. It's not one homogeneous single market, as we all know. What falls under that category of emerging markets and developing markets encompasses everything from China and India to Ghana and South Africa to Venezuela. You've got a global number of countries that are in that bucket, and none of them are the same. So being aware of that risk and be able to mitigate by diversification across markets for an asset manager like Invesco is always critical. Our participation in the market, though, and this is the reality, this is where I may be a little bit more of a downer in today's conversation. The reality of allocating into emerging and developing markets is it's always driven for a firm like Invesco by investor willingness to participate. This is not a core allocation component for most developed market portfolios. It is always a periphery, a satellite. It's a small slice in their portfolio. And the amount of assets that they're willing to allocate into emerging developing markets limits the amount of investments that we can actually direct and the themes that we can support. It was pointed out earlier by Noelle, I believe, Rahul hit on this, and excuse me. And Amundi covered this also. For these investments to be successful, they must be commercially attractive. There are very few investors that are willing to sacrifice return, even those that are focused on sustainability and ESG. Commercial attractiveness is key. We saw that with the presentation earlier by Angela about the ETF in China. Assets will flow out if performance isn't there. In order to drive investment at scale, we need to make sure that we have risk mitigated, alpha aware type investment allocations where we're tracking for sustainable investors, sustainable inclined investors, those KPIs that are relevant and appropriate and material to the portfolio that we've built for them. A final comment from my side, we've talked a lot about SDGs today. And for emerging and developing markets, the SDGs are a critical benchmark. They were designed intentionally to help support programs and capital allocation into these markets to to bring people to a better standard of living globally. My fear, and fear of a lot of my peers, is that the SDGs actually risk being eclipsed as we go into 2022 by a focus on net zero. As we're leading up to COP26, as we're focusing on net zero commitments and decarbonization, the key component of these 17 SDGs, they tend to be fading into the background. Climate is sucking a lot of the oxygen out of the room, and frankly, it's sucking a lot of investments out of the market that are being allocated in those type of investment vehicles. So I think particularly for emerging and developing market strategies, that awareness of and focus on SDGs is going to be critical in the coming years. One last comment, the investing landscape today in this space is not going to be the same as it will be in 2030. It is amazing the amount of growth. It is amazing the amount of opportunity. The change in governance structure and the willingness of large investors to allocate is just increasing. But there are risks that are going to have to be accounted for as we do allocate, particularly as it relates to investment vehicles and local regulatory support for these type of investments and focus. So Joseph, I'll turn it back over to you to close this out here.
Glenn, thank you very much, and thank you very much for very briefly, very succinctly giving your view of the market, maybe bringing us down to earth a little bit, which is always important. The two points you make that I'd just like to mention, and maybe people can come in as well, the speakers can come in. One is the different contexts. We've been talking a lot about emerging markets, talked a lot about Asia, India, China, Philippines. But you mentioned Ghana, and of course, there is these what sometimes referred to as frontier markets. And I just wonder if you could say a little bit about Invesco's exposure to these markets and the appetite for risk there, which is obviously, very, very low. It's very low appetite. Secondly, when you talk about the SDGs being eclipsed by net zero, this is a very important point. A lot of the say if you to look at ETFs, 80% of sustainable ETFs, ESG ETFs, are focused on climate and clean tech, and some of the other goals, some of the other areas, don't get a look in and need that capital too. So this is an important point going forward, especially for the UN, especially from a communications perspective as well. This was a point that was brought up in our session on Monday. The SDGs are quite good at communicating the idea of sustainable topics like climate and renewable energy, much more than ESG, which is maybe a bit esoteric for people. So we need to, in the UN, we need to be careful as well about how we communicate on some of these issues, perhaps the idea of net zero and the SDGs and the complementarities and perhaps conflicts between those. So I should stop there. We've gone over, but we've got a couple of minutes left for anybody else that would like to follow up or ask a question to Glenn.
Joseph, actually, to address the two questions that you sort of posed there, one on Invesco's perspective towards Africa. We just recently, within the past 24 months, appointed our first head of Africa. Gwen Smith is leading our operations and our efforts in that area and is rallying basically the investment managers across Invesco globally to further consider what we're going to do in that market. The amount of growth there, particularly, I can keep coming back to Ghana just because of the amount of growth that we've seen in that one country within a very much heterogeneous market space. We believe that there will be opportunities there, and we will be allocating as we move into 22 and 23 a bit more aggressively there. Very similar to the way that we've been looking at India with very fresh eyes coming into 21 and into 22. We see real investment opportunities in all of those. And the nice thing is most of the products and strategies that are being developed for those markets by Invesco's portfolio managers are focusing on sustainable strategies as the core thesis and how we're allocating. On the latter, I do want to point out one of the reasons why I'm concerned about net zero sucking more of the oxygen out of the room is it's a great, simple marketing plan. It is very easy to explain. It is one concept of net zero emissions by a target year of 2050. The SDGs are a little bit fuzzier. They accomplish more, they cover much more ground. People's attention spans are very limited. So something like net zero is easier. It's an appetizer. It's a single thing that they have to consume rather than sitting down at the full meal of the SDGs. And we just need to be aware of that.
Yeah, exactly. Very, very important point. Yongfu, I see. No, sorry, Angela, your hand is raised. Angela, you have a question for Glenn.
Yeah. Glenn, I think it's thank you very much for your candid sharing, particularly for this SDG kind of fitting point. I hope not. If yes, I think it's going to trigger the bigger crisis, because fighting the climate change alone will not be successful unless supported by the SDG goals, because it's the whole. I think the people, profit, and planet are highly interactive. I think so. We are one. So if the whole world are gonna go to the climate change fighting alone, I think it's without SDG, the efforts, I think going to be a bigger disaster. It's but back to you mentioned risk and affair a lot of times when you are allocating this ESG investment in emerging markets. So could you tell me what will be the top three? It's when you invest in emerging market, perhaps the geography is too big for you. For example, China, India, and Africa, which, for the three different geographies, which risk gonna top, for your ESG investment?
Angela, there's not a single, right? We're talking about very different markets with very idiosyncratic exposures. Even in China, something like the topic of climate, the risk is different province to province. The ability to negatively impact supply chain for a company that's primarily operating in the south of the country is going to be very different than what happens for someone who's a little bit further north. And so we're building up the expertise to understand those idiosyncratic risks in the regions that we're describing here. Invesco's history is not as an emerging market investor. This has always been a small slice of what we do. And so, Angela, I think we're catching up on how we're looking at these globally. And the data availability is going to be key to understanding that. We've hit that a couple of times in your remarks and others today. We have to have actionable data that we can trust to be able to accurately assess risk in these different markets. The final piece on risk is not static. There's the risk at the company level and then the industry and the regional level. But the risks that we're seeing today are going to be very different from what we see 5 years from now. And being able to dynamically understand and adapt is going to be a key. And that is different than in your existing mature developed markets, right? The risks are a little bit slower moving in those markets. And for investment managers, it's easier to adjust, to turn that freighter in that particular sort of a course adjustment. That is that very quick adjustments that we need to make in emerging markets.
Thank you very much. Yeah.
Yongfu, a last question from yourself.
Yeah. Hi, Glenn. Thank you very much for sharing your insights with us. From our discussion today, I really see a lot of shared challenges for all the sustainable investors. In the areas of data accessibility, fragmentations of standards, and the reporting issues, etc. And each financial institutions, including among the generous associations and maybe also Invesco, you are investing a lot of resources to addressing these issues. I just would like to have your thoughts about the potential or the opportunities for enhanced collaborations between different players in the markets to work together to address these issues. What would be the opportunity areas in your view? And also because UNCTAD now we have already launched a couple of initiatives and programs with aim to work closely with the industry and also with governments to address the commonly shared issues. So I would also like to hear your advice on the possible role that UNCTAD or similar UN organizations can play in this, in this exercise? Thank you.
Thanks, Yong-Fu. Those questions are, we could probably spend another 30 minutes just on those questions, but I have to actually give an ironic answer on the collaboration one, which is net zero. Why has net zero been as effective? Why is it posing the risk that I'm describing? Is because they've effectively grouped stakeholders into buckets that are applying complementary pressure across the ecosystem in finance. The asset owner initiative within net zero is forcing us as an asset manager to look at what's at risk. So what would have been a peripheral issue for most of our investment managers 9 months ago is now front and center. And it's not because the regulatory environment has yet changed. It's because those investors have came to us and put pressure on us to make the move. So being able to, it's not one part of the ecosystem that has to be activated, Yong-Fu, it's got to be multiple. The group that has the most pressure for us, for asset managers in particular, is going to be the asset owners, the significant institutional asset managers, or sorry, asset owners, the pension plans, the sovereign wealth funds, et cetera. They have a huge stick that they swing at us to make sure that we comply. And Caroline can attest to this at Amundi, I expect. If a very large institutional client comes and they're moving towards SDGs, they're moving towards gender diversity, they have a theme that they want to execute on, we make a movement. When we move, that means regulators get pressure from us. And the regulators get pressure to increase and support disclosure, to ensure that we have access to data that's actionable, to ensure that the safeguards are in place that we're protecting and abiding by the fiduciary responsibilities. There's multiple points on this that can be activated. The final thing I will say is marketing matters. And this is where the SDGs were very successful. The 17, the way it was presented earlier in its rollout with the colors, the groupings, et cetera, incredibly successful. Net zero has been successful because it's a very simple, concise message. We need to boil things that we're asking to do in sustainable investing to memorable sound bites for investors so that they can retain that over time with that cacophony of noise they get from all the things coming through the media, the press, and marketing from other channels. It's got to be something that stays in their minds.
Well, thank you very much, Glenn. I think that's an important last point to end on, a nice message to end on. And thank you to all of our participants, all of our speakers in today's session, to Glenn, Caroline, Angela, Rahul, and Noelle, who had to leave us earlier. It's been a fascinating discussion. The video will be shared next week and on our channel, UNCTAD Investment. And thank you very much again, and very good night, good day, and goodbye. Thank you.
Thank you. Bye.
Thank you very much. Ciao.
Bye-bye.